Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special housing report brought to you in association with ASB. Today we're going to have a look at wholesale interest rates. These are the ones that determine fixed mortgage rates, which so many New Zealanders roll onto. And you can see here in this first chart on the 1-year swap rate, which is used as the underlying pricing mechanism for often short-term mortgages, that we've seen a blip up in the last 3 or 4 weeks from around 3% to about 3.5%. That's because many people are choosing to go off floating and onto fixed as they move to buy a house, particularly as we head into the spring buying season. And you can see here in the second chart here on the 2-year swap rate, which obviously is underpinning the 2-year fixed mortgage rate, there's been quite an increase from around 3.9% to 4.4%. And then, of course, right out at the 3-year mark, we've gone from about 4.6% to over 5%. What does this mean for mortgage rates? Well, it's likely that fixed mortgage rates will continue to edge up at the same time as floating mortgage rates stay the same or possibly even dip a little bit. We've certainly got a positive sloping yield curve at the moment, something unusual for New Zealand. And it's meaning that people who are rolling over their fixed mortgage rates aim to think more than once about whether they continue to stay fixed. For now at least for the next few months, those floating rates are likely to be at the low point or even lower than some of the short-term fixed mortgage rates. So if you're looking for the absolute cheapest right now, those floating rates are cheaper. But the big issue here is what's happening with interest rates in the next year or two. Well, these wholesale markets are telling us people expect interest rates to rise over the next year or two, possibly up towards the 7% mark for many of these fixed mortgage rates. So it all depends on your own personal situation, whether you want to continue to pay off your debt as you go. A variable rate works best for that. If you're looking for the absolute cheapest rate and for some certainty on your outgoings for your mortgages, then a fixed rate, particularly a shorter term one, still looks best. But the gap where it was obviously cheaper with a fixed rate in the past and a floating rate, it's not quite so obvious. So people are having to think twice. One way to hedge your bets, of course, is to have both fixed and floating. So you can keep paying it off, but also have some certainty about some of your mortgage. I'm Bernard Hickey. That was a special housing report brought to you in association with ASB.